In this video, I am going to analyze media companies which are into newsprint as well as audio visual. The companies we are going to analyze in this video are DB Corp, Jagran Prakashan, Hindustan Media Ventures or HMVL, HT Media, which is a parent of Hindustan Media, and UFO Moviez. Most of these companies are small cap companies. So let us begin with the DB Corp first. The current market price is 193 rupees, and the price difference from its 52 weeks high, that is where the price was 52 weeks back, from there it has fallen by 32%. Most of the companies have also fallen at a higher rate. The highest fall was seen in HT Media at 61%, followed by Hindustan Media. Hindustan Media is a subsidiary of HT Media, and then followed by UFO Moviez, which fell by 53% from where it was 1 year back or 52 weeks back. The earnings per share of DB Corp. This is the earnings which are recorded in the last 4 quarters. DB Corp's earning per share worked out to 15 rupees per share. Therefore, the yield worked out to 7.9. The yield basically measures the profit earned on each share against the current share price. That is, on a share price of 193, what was the earnings of the company? It was 15 rupees. That works out to 7.9%. So earning per share comparison would not make sense till we use this and compare it with the current market price. Then we get a yield, and then we can measure the yield to understand which company has earned the highest return at the lowest price per share. So the earnings yield for DB Corp was 7.9%, Jagran was 8.3%, HMVL has earned 10%, and UFO Moviez has earned 12% on the price. Next, let us look at the price earning of the latest 12 months. This ratio basically compares the current market price with the trailing 12 months earnings per share. That is, how much was the earnings in the recent 12 months or recent 4 quarters, and compare that with the price. So we understand the price to earnings multiple, or basically, in other words, how much or how many times more are investors paying against the earnings of the company. So the recent price to earning multiple was 12.64 times, meaning investors had to pay, if they wanted to buy the shares, investors will have to pay 12 times more than the company's earnings. To put it into example here, earnings was 15 rupees and investors were paying 193 rupees for that share. That is 12 times more than the earnings. This ratio basically is a valuation ratio which helps investors understand where the price is, how expensive or how high or low the price is when compared with its earnings. Jagran's price earning of the recent 12 months is 12 times. HMVL's price earning is 9.9 times. So what we want to see here is a price earning multiple, first of all below 25 times. Then if it is below 25 times, then we also want it to be as low as possible in terms of the peer group. HT Media had a negative price to earnings. The reason for a negative price to earnings was basically the company's earning per share was in loss. That is, the company had made a loss in the recent 12 months. and the loss per share was 1.33 rupees. That is why we have a negative price earnings ratio here. UFO Moviez price earning multiple was 8 times. We would never want to see a negative price earnings. The price will never turn negative, but the earnings will. So that is why we will get a negative price earning. So whenever we get a negative price earning, that is a value which is not strictly comparable. Let's move on to the next ratio, that is the historical 5 years price earning, which basically calculates the average price to earnings ratio which was available during the last 5 years. So historically, or on average, what was the price and earnings multiple that the investors were willing to pay, and even during the last 3 years, what was the price and the earnings multiple investors were willing to pay. So DB Corp's price to earning for both historically 5 years and 3 years was 20 times, whereas in the recent year the price multiple has fallen to 10.9 times, and in the very recent 12 months earnings it is 12 times. So it has fallen even below the average, which is a good which suggests that it is a good price earning multiple because we are getting it below the 5 and 3 years average. Jagran's historical 5 years price earning was 15 times and 3 years historical price earnings was 16 times, whereas the current price earning was 10 times and 12 times in the recent 12 months earnings. So here too we see that both the last year's price earning and the recent 12 months price earning is below the average. This is what we would want to buy in terms of valuation, whether we are getting it at a reasonable rate. Hindustan Media was historically trading at 10 times for both 5 and 3 years, whereas currently it is at 9.9 times using the 12 months earnings data, and in the last year it was 4.18 times. That is, the price was 4 times higher than the earnings. Very reasonable price earning multiples we are getting it. So whenever we see these kind of price falling very near or coming very near to the earnings, or the earnings going up towards the price and price earning multiple falling at a very low single digit, that's a buying opportunity provided other ratios are also up to the mark. Just looking at the price earning multiple and knowing that we are getting it cheap does not make the stock good. We have to understand how the company is returning money or earning profits on shareholders' money, or even on borrowings that the company has done. And there are many more ratios that one needs to check and build a picture out of these numbers. These numbers are not just numbers, they will tell you a story once you understand what these numbers are stating. Till you don't understand the ratios or the numbers that you're reading, it will not make any sense to you. It will be just like a foreign language, which if you don't know or you haven't studied it, you will never understand it. So investors would have to understand these ratios and look at the components of these ratios and what are these ratios meant to be used for. HT Media was trading at 11 times more than its earnings of the historical 5 and 3 years. In the last year, the price earning fell at a very reasonable 2.2 times, but in the recent 12 months, because of a loss, the price earning multiple has turned negative, which we generally would not want to see. UFO Moviez 5 years price earning multiple was also trading at 18 times, and the current is way below the average at 8.4 times and 8 times in the recent 12 months. So in terms of how much the stocks fell from its 52 weeks high, the highest fall was seen in HT Media at 61%, whereas the lowest fall was in Jagran Prakashan only at 27% from its 52 weeks high. So the lower the fall, the more strength it shows. Next, in terms of earnings yield, the highest earnings in terms of against the price was UFO Moviez at 12%. That is on a price of 188 rupees. The company has earned 23 for every share. Whereas the worst performing was HT Media, which had a negative earnings yield. That is, it had a loss of 5.1% for each shareholder. In terms of recent price earning of the 12 months, where the price was compared to its earnings, the lowest or the cheapest one available at the lowest valuation was UFO Moviez at just 8 times, and the most expensive in terms of it being a negative is 19.62 times HT Media. When we look at the last year's price earning multiple, the most expensive scrip was DB Corp, available at 10 times its earnings, and the cheapest one again was HT Media at 2.24 times. So when we look at from the previous year, because of a loss, the company's price earnings multiple has totally gone for a toss, and we see that last year it was the best or at the best valuations compared to where it is in the recent 12 months. Historically, if we see HT Media at the most reasonable valuations in terms of price earning at just 10 times, and the most expensive was DB Corp at 20 times its earnings. Next, let us look at the current market price to the operating cash flow. It basically compares the price with the operating cash flow of the company. The difference between the earnings and the operating cash is that the earnings considers all cash as well as non-cash expenditures and income to come to the net profit figure, whereas cash from operations considers only the cash inflows and cash outflows out of the operations of the business. So there are three activities. One is operation activity, the other is investing activity, and the third is financing activity. So here in this particular OCF ratio, we are looking only at the operating activity, and that too only cash inflows and outflows. We don't consider non-cash incomes and expenditure while calculating the OCF. So the price to OCF was 9.28 times for DB Corp. That is, investors were paying 9.28 times more than the company's cash earnings. Here, as similar to price earning, where we want it to be below 25 times, in terms of operating cash flow too, we would want to see the ratio below 25 times. We don't want to pay a very high price against what the company is earning as cash every year. Or most of the companies have a single digit price to cash earnings ratio. Jagran's is at 7.9 times its cash. Hindustan Media's price is 5.8 times more than its cash earnings. HT Media's price to cash seems to be at the lowest and the best available at just 1.9 times. In terms of earnings, it has not managed to convert, and the ratio has turned negative because of the loss. UFO Moviez price to OCF stands at 5.65 times. Next, let us look at the price to free cash flow. This particular ratio compares the current market price with the free cash flow of the last year, and this ratio is on per share basis. So what happens here is we are comparing the free cash flow of the company for every share against the price of the share. This helps us in again giving us an idea as to where the price is in terms of free cash flow of the company. Now this free cash flow is basically an operating cash flow, and you remove out all expenditures incurred on fixed assets, buying of fixed assets, and you add, if some assets are sold, you add that back into the operating cash. So free cash flow basically helps us understand out of the cash earned through operations how much more was spent in investing activity, and then after that whatever remains is the free cash flow. So here too we don't want it to be more than 25 times. Now this 25 times that I have kept as a benchmark for myself is not a short value that investors can look at. Someone may want it to buy not giving a multiple of more than 20 times. That's okay. It depends on individual to individual where they are more comfortable. Someone will just want to give 5 times more than the earnings of the company, or cash earnings of the company, or free cash flow of the company. So that's all right too. It depends on the individual's goal, or how low someone wants to buy. So in terms of free cash flow, DB Corp price to free cash flow was 18 times, and Jagran's was 9 times. So this is much better. Hindustan Media was available at 6.92 times, which is even better. And HT Media's price to free cash flow is still better at 1.91 times. UFO Moviez price was 14 times higher than its free cash flow. So we want these to be also as low as possible in terms of valuation. But we have to remember here, the number being low just creates an opportunity to buy, provided other ratios are in order and at good valuations and at good profitability, and other ratios too should match up to our criteria. Now as we go down, we'll understand each ratio separately. Next, let us look at the price to the book value. This ratio basically compares the book value of the company against the market value of each share. Book value basically means what the company is valuing its stock at. Compared that with the market, which is valuing the stock in a different way. So we have two different values for the shares. One which is given by the company, which is the book value, and one which is given by the market, which is the market price. So this ratio basically is a very good metric to understand where the share price is actually compared to what the company is saying the share is worth. DB Corp's shares is trading 1.8 times higher than its actual shares value. Jagran is trading at 1.6 times its book value. Hindustan Media is trading below its book value. That is, whatever the company is saying is its shares value, market participants are discounting it. They are even giving it a lower valuation than what the company is saying its shares are worth. When the company's price to book value goes below 1, that time is a very good time to buy into the company, again provided the other ratios are matching up to the fall in the price. Many times the fall in price is not in direct connection with the fundamentals of the company. The fundamentals may be very good, but due to a short duration, there could be a mismatch between the price and the fundamentals of the company, and that is the time we should generally buy into these companies. Although when buying during this time, the market price would definitely fall and we would see a red in our portfolio, but that should not affect our basic understanding that the company's fundamentals are intact and the price falling is not in direct relation with the fundamentals of the company. So that's the time to buy into the company. So valuation wise, it has available at a discount to the shares book value. HT Media is also trading at a heavy discount of 0.25 or 1/4 of its book value. UFO Moviez is very near to its book value. So we can see most of these companies are trading very near to their book values. Here the criteria is to have a price to book ratio below 2.5 times. Up till 2.5 times it is reasonable. Anything above that is expensive. Again, this ratio is my benchmark. It could vary with different investors. Some would not want to pay more than 1.5 times. Some would want to buy at 1 times. But most of these companies you will never get it at 1 times, because there's always for good companies there is always a premium that the market pays. Next, let us look at the price to sales. This is also per share basis. This ratio compares what was the sales for per share basis and what was the price per share. So this ratio helps us how much sale the company is doing per share against the price of the company. This is again a very good metric to understand. DB Corp's price was trading 1.3 times higher than its sales. So we want this ratio to be as near to 1 as possible. If it goes below 1, that too is okay, because here it shows if it goes below 1, it means that the company's total market cap is below its total sales of that year. For example, if the company has done a sales of 100 CR and the market cap is, that is the total values of all share, is also at 100 CR, 100 CRs of sale and 100 CR of market cap, that means a ratio of 1, which is very good. We don't want to see 100 CR of sales and say 500 CR of market cap. So that is 5 times more than its sales. We want the sales to be as high as possible to the market cap. Jagran sales and the market cap of the company is very nearby, 1.3 times. That is, market cap is 1.3 times higher than its sales. Hindustan Media's market cap has fallen below its sales. Now the sales is more than the market cap of the company. This is a good valuation that we can look at. HT Media's market cap has fallen below the sales by 0.28%. That is, the entire market cap of the company is just 0.28% of the sales. UFO Moviez is also available at a discount to its sales value at 0.87. That is, price was 0.87 times its sales. So here, as I mentioned earlier, we want the price to sales ratio to be as near to 1 as possible. The further away they are, the more expensive the stock is. Now these were all valuation metrics that we just saw, and they help us understand the price level or where the price is compared to different variables of the company. So in terms of price to OCF comparison, DB Corp's was the highest at 9.2 times, and the most economical was HT Media, available at just 1.9 times its cash from operations. In terms of free cash flow also, DB Corp was the most expensive. In fact, even in terms of book value, it was the most expensive of the peer group companies. And as so was for the sales at 1.3 times its sales. That is, the price was 1.3 times more than its sales. And in the same breath, HT Media was the best for all of these ratios. So these ratios tells us that the current price of HT Media is the most or the best or has fallen the most to be the most attractive of all the companies. Let us look at the profit growth rate of the companies in the 5 years. This is the compounded growth in profit after tax over last 5 years. That is from how the profit has grown where it was 5 years back and where it was 3 years back. DB Corp's profit has been growing at the rate of 8% in last 5 years. Jagran's profit has been growing at 2.67%. We want the profit growth rate to be as high as possible and preferably above 10%. HMVL has managed a 15% growth rate over a period of 5 years. HT Media 2 has done a double digit of 10% and UFO Moviez at 9.5%. In terms of 3 years, DB Corp's profit growth rate has fallen down or the growth rate has slowed down to 0.76 over a period of 3 years. Jagran's profit has increased from 2.6% in last 5 years to 4.93 times in the last 3 years. So we want to see these kind of growth rates, but here the base of 5 years itself was very low. So compared to that, this is good, but overall we want at least 10% growth rate year on year. HMVL's profits have slowed down from 15% to 6% in the last 3 years. But HT Media's profit in the last 3 years has grown at the rate of 12% from where it was in 5 years, that is at the 10%. UFO Moviez profits have fallen slightly at the rate of 8.4% from the 5 years average of 9.5%. So what we want to see here again is a double digit growth rate of above 10% in growth in profits. Now let us look at the PG or the price earnings to profit growth rate of the 5 years. This is calculated by taking the price to earnings ratio and dividing that by the profit growth rate of 5 years. We have already seen above in the previous ratios what is price to earnings. So we take the recent 12 months price to earnings data and divide it by the past 5 years profit growth rates. So this helps us understand how much we are paying for the earnings of the company through price and earnings and how that earnings is growing. So basically if you're paying say 20 times the earnings and there's a good high growth rate in earnings also, then that becomes a good price earnings ratio to pay for the company. So even if the price earning ratio is say 40 times but the profit is growing at the rate of 40%, so even that price earning is justified at 40 times. But as far as possible we should avoid going in for such high PE ratio based companies until and unless we also see a similar time of profit growth rate in those companies. So we want to see a ratio or a number below 1.5 times. Whenever we see a number below 1.5 times, that signifies that whatever price earning we paid or price earning multiple we paid for the company, that is justified because we are also getting a high growth rate in profits. The only companies that I see in terms of last 5 years, HMVL was below 1.5 times, and even UFO Moviez was below 1.5 times, and HT Media had a negative PG of the last 5 years. The reason for that is the current price earning value had turned negative. If we go up again here, we saw the price earning multiple of the 12 months was negative. Therefore, the ratio turns negative for PG of 5 years at minus 1.94. So we don't want to see a negative value first of all. Second is we would want to see a PG between 0 and 1.5 or less than 1.5 and not a negative PG. So whenever we see a negative PG, the price earning multiple that we have paid is not correct, or we will want to buy it even lower than that multiple. Especially when the company is in loss, then we have to in fact wait further for the price to fall so that we can buy, if we want to buy, at a very low discount. So here if you look at Hindustan Media Ventures, we see 0.66, which means that the price earning we paid in the recent 12 months was 9 times. That is, the price we paid was 9 times more than the earnings. But we also saw that we were getting a growth rate of 15% over a period of last 5 years in the earnings. That itself shows that our capital that we paid, invested in the company by paying 9 times more, we'll be able to recover it much faster. Had the earnings not grown at all, then it would take us 9 years just to recover our capital. But here the earnings is growing at the rate of 15%. Therefore, our initial investment will be recovered much faster. But in terms of PG of 3 years, it is exactly at 1.5 times. That is, we are paying 9 times the earnings. But in the recent 3 years profit growth rate, we saw that the profit was growing at the rate of 6.6%. Therefore, the PG works out to 1.5. So this is the metric that we want to look at for PEG. PEG is also an important ratio that we should look at. So in terms of growth in profit over a period of 5 years, we saw that HMVL has grown its profit at the fastest percentage rate of 15%, whereas the lowest growth rate in profits was of Jagran Prakashan, growing its profit at just 2.6% every year. In terms of 3 years, DB Corp had the lowest profit growth rate of 0.76%, less than even 1%, and HT Media managed to grow its sales, or its profit in fact, at the rate of 12%. PEG wise, the best in terms of 5 years or over a period of 5 years, Hindustan Media has done the best at getting a ratio of just 0.66. And HT Media, its parent company, has done the worst at minus 1.94. So even the price earning multiple, whatever we are paying for the company, is not justified in this case. Same is for last 3 years, which had a negative, HT Media had a negative PEG of minus 1.52, whereas the best PEG was for UFO Moviez, available at just 0.94 times. Next, let us look at the sales growth rate of the company over a period of 5 years. This is the compounded sales growth over the last 5 years. And then we'll also look at how the sales has grown over last 3 years. Sales is an important metric to look at for any investors, because sales is a starting point from where a company earns its revenue, and the entire flow of the accounts starts from sales. If the company's sales or its product is not in demand and the company's sales falls, that will directly affect the profit of the company, and in fact it will affect all the ratios of the company. And this is the starting point to understand why, if there is no demand or if the sales is not increasing, or in fact sales is dropping year on year, or from even 5 years back, or from 3 years past, then that's a sign of worry that investors should be aware that the sales is falling and there are some problems in the company, and it should be a starting point for the investor to be on little bit alert about the company. DB Corp's sales over a period of 5 years has been growing at the rate of 7.9%. Jagran Prakashan has managed to grow its sales at the rate of 8.6%. Other companies too have performed poorly. UFO Moviez sales has grown at a double digit 12% growth rate. So as investors, we want to see a high growth rate in sales of at least 10% and above. Even when we look at the growth from 3 years back, we see that DB Corp's growth has further decreased by 5%. Jagran Prakashan's sales has increased slightly by and to 9%. HMVL's sales has dropped to 2.4%. So whenever we see a drop from 5 years to 3 years in sales or profit, that's a problem for the company. What we want to see is the growth rate increasing as the years decrease. So when we look at the 5 years growth rate and the recent 3 years, we should see a faster growth rate in the recent 3 years rather than it going down further than the 5 years growth rate. HT Media's sales has also dropped from its 5 years growth rate. Same is the case for UFO Moviez. Its sales has grown at the rate of 7.4%. Next, let us look at the return on equity. This ratio measures the weighted average of return on equity over last 5 years. That is, what is the profit that the company is earning on shareholders' money or funds invested by shareholders. So when we look at the RoE ratio, it measures how much profit a company generates with the money shareholders have invested in the company. Now, the RoE of 5 years measures the average return over a period of 5 years that the company has given on shareholders' money. DB Corp RoE was 23%. Jagran Prakashan's RoE over a period of 5 years on average was 18%. Here we want to see a value of at least 15% and above. HMVL has also returned 18% on shareholders' money. HT Media and UFO Moviez have fallen short of 15%. Let us look at the recent RoE. DB Corp's recent RoE is 18%. Now what we want to see is the latest RoE value to be above the average of the last 5 years. That shows that RoE has increased over a period of 5 years. Jagran's RoE has also fallen below its average. Same is the case with HMVL, where the average was 18. The latest year's RoE has fallen to 13%. UFO Moviez has managed to increase its RoE above its average. Let us look at how RoE has grown for most of these companies over a period of 5 years. DB Corp's return on equity has dropped by 3.82% over a period of 5 years. Jagran's RoE has fallen at a steep rate of 14% over a period of 5 years. HMVL RoE has fallen at the rate of 5%. That is, the return on equity ratio as measured 5 years back and as measured today has been dropping at the rate of 5.3%. The other two companies, HT Media and UFO Moviez, have managed to slightly increase their ROE from where it was 5 years back. Next, let us look at the return on capital employed of 5 years. So this is the weighted average return on capital employed over a period of 5 years. Now what is RoCE? It is basically how much earnings the company had against the total capital employed into the business. Now this return or profit that you are measuring here is the EBIT, or earnings before interest and tax, and that we divide by the annual average capital employed and not the single capital employed of the latest year. So we take this year's capital employed and the previous year's capital employed, we average it out, and the EBIT is divided by this capital employed. Now capital employed is consisting of fixed assets plus working capital. Working capital is made up of current assets minus current liabilities. Now what is current asset? Current asset is those assets which can be sold off in this year or in one financial year, whereas current liabilities are those liabilities which have to be paid within one financial year. So we have the fixed assets plus any working capital that the company has employed into the business. So the RoCE also has to be above 15% at least for most of these companies. DB Corp's RoCE is 33%, and if you look at most of the companies have managed to give a good return on its capital employed, except HT Media, which fell short to 14.11%. These are the average of last 5 years. Now let us look at the current RoCE ratio. Again, the current RoCE should be above the average, which shows there is a growth in RoCE. DB Corp's RoCE is 27% for the latest year, and it has fallen short of the average. Jagran Prakashan's RoCE is 19% and below average of the last 5 years. Same is the case for HMVL, where recent RoCE was 17% and below last 5 years average. UFO managed to increase its recent RoCE above its average. So we are looking for above 15% and the latest RoCE to be above the average RoCE of last 5 years. Next, let us check the return on assets of the last 5 years. This measures the average return on assets over a period of 5 years. Now we also have to understand what is asset employed into the business. This is the total assets of the company, includes each and every asset, and we reduce the current liabilities from that. So this gives us the return on assets ratio. Return on assets ratio should also be above 15% as far as possible. DB Corp and HMVL have managed to keep RoA above 15%, and all the other three companies, Jagran, HT Media and UFO Moviez, have fallen short of their RoA target. Next, let us look at the assets turnover. This is the annual sales divided by the annual assets. Here we want to understand how many times the assets were converted into sales, or how many times more was the sales when compared with the assets of the company. Now the assets employed into the business here in this particular ratio is the net worth of the company plus borrowings of the company. So this is the total asset employed by the business into the company. Here we want the ratio to be as high as possible. That is, we want the sales or the assets to be turned over as much as possible into sales. So here we want a very high ratio as far as possible. Most of these companies have not managed to substantially increase their assets or convert their assets into sales at a high level. In fact, HMVL's sales has dropped below the assets that it employed into the business. Same is the case with HT Media, where its sales fell short of its assets deployed into the business. The other three companies, DB, Corp, Jagran, as well as UFO, managed to increase their sales or convert their assets into sales at a slightly higher rate. Next, we'll look at the return on invested capital. This is the operating profit divided by the invested capital. Here, the invested capital is composed of net block, that is the fixed assets minus the depreciation. So this is the net assets that we have plus the working capital. In the previous example, in return on capital employed, we saw that it is composed of fixed assets and the working capital, whereas in invested capital we have net block, that is net assets plus the working capital. So this is only looking at the net assets of the company. Add to that the working capital that is deployed into the business, whereas RoCE is of fixed assets, that is the all assets of the business which are fixed, and this also includes the depreciation before deducting the depreciation. So ROIC of DB Corp was 32%. Most of these companies have earned a good ROIC of above 30% almost. So in terms of sales growth over a period of 5 years, UFO Moviez have done the best by growing their sales at the rate of 12%, whereas HT Media's sales had a mere growth rate of just 2.76%. In 3 years growth rate, Jagran has done the best by growing their sales at 9%, and HT Media again has done poorly at increasing its sales by just 0.94%. In fact, in most of the ROE ratios and RoCE as well as RoA and ROIC, HT Media has done the worst. ROE is best for DB Corp, and it has earned the highest return on equity shareholders' money for both the latest year as well as on average. Return on capital employed was over a period of 5 years again was best for DB Corp, where it managed to earn 33% on the capital employed into the business, along with the recent RoCE. Even on return on assets, it was the strongest, earning 21%. Not only that, it converted its assets into sales by 1.18 times. So most of the parameters in terms of profit earning is very good for DB Corp. HT Media has done poorly. The ROIC is the highest for HMVL or Hindustan Media at 60%. Let us continue with the next ratios. In this part, we will look at the profit after tax of the last 5 years. That is how much profit the company has earned over a period of 5 years. And then we'll look at how much of that profit has got converted into cash. That is, how much cash has come in through operating activity over a period of 5 years. And then we'll look at the free cash flow that is there with the company. Now this free cash flow is basically the cash coming in from the operating activities, reducing fixed assets purchased from that, and any assets which are sold are added back. So what we finally get is the total cash inflow or outflow out of the business through operations as well as through investment activity over a period of 5 years. So this three ratios we will be using by comparison of CFO with the PAT, then free cash flow with the cash flow from operations. So what we are looking at in this ratio is basically how much of the profit or how much of the earnings of the last 5 years has got converted into cash. Then in the next one we are looking at how much of the cash flow from operations has been utilized in investment activities. Here we don't want more than 50% of the cash flow to be used up in investing activity. This is just a benchmark. It is no set rule that company cannot use or should not use. I have set a benchmark for myself that company should have at least 50% of its cash from operations free for use for acquisition, for dividend, for bonus, or whatever company wants to do for with that free cash in terms of financing activity. So let us look at these 5 ratios together. DB Corp in the last 5 years has earned 1615 CR. Out of that, the company's cash earnings were 1700. So this is a good thing. Company has earned more cash than its earnings. So we have a ratio that the cash is 8.28% more than the earnings. In terms of free cash flow, the company's cash from operations was 1700 CR. Out of that, company still had a free cash flow of 1100, which means the company hasn't invested too much into investing activity. So we have this ratio here which says that whatever company had earned as cash from operations, only 34% of that has been spent in the investing activity, and we still have 1145 CR as free cash flow. So we don't want this figure to be more than 50%. That is, the company's cash flow from operations should not be utilized more than 50% in investing activity. Let us look at Jagran's profit after tax of the last 5 years. The company earned 1330 CR as profit over a period of 3 years. It too received a cash of 2000, which was higher than the profit of the 5 years, which is a good sign. So that was 55% more than its earnings. In terms of cash or free cash flow, only 16% was utilized in the investing activity, and the company still had 1725 CR with it lying idle for financing activity. So this too is good. Hindustan Media's profit was 795 CR. Out of that, it received 679 CR. So here we see that the cash conversion in profit into cash conversion is less, and it is less by 14%. So this is not what we should want to see when we invest in a company. That being aside, the free cash flow is 501 CR. So that at least is better in the sense that only 26% of that has been used in the investing activity over a period of 5 years. Let us look at HT Media's profit was 995 and 1500 CR of that came in through cash, which was 51% more than its earnings. Besides that, its free cash flow was 56% short of the cash flow from operations. That is, out of the cash earned through operations of 1500 CR, only 650 was left free, and rest of was invested in buying of fixed assets. So this ratio again is not good for HT Media in the sense that it has crossed above 50%. But as I mentioned earlier, this is not something which is fixed, or this ratio or this benchmark is not fixed. Let us look at UFO Moviez 283 CR of profit and 613 CR of cash. That is more than 116% more than what it earned as profit. And 55% of that was utilized in the investing activity. So whatever company had free was somewhere around 45%. So this is a good ratio to look at. So in terms of CFO to PAT, UFO Moviez managed to earn the highest cash in terms of against the earnings of the company, whereas Hindustan Media fell short by 14% over a period of 5 years. When we look at the free cash flow, maximum of the cash from operations used up was by HT Media at 56%, and the lowest investment done by of the group companies was by Jagran Prakashan, utilizing just 16% of its cash from operations into investing activity. Next, we will look at 7 ratios together and try to understand how these companies have done over the past 1 year. So we will be looking at 7 ratios. The average PAT during the last 5 years that the company has earned, and we will compare that with the current 4 quarters or 12 months of earnings and see whether the 12 months of earnings is above the average of the last 5 years or below the average. Next, we'll look at the profit after tax of the previous year and compare that with the current 12 months earnings. Next, we will look at how the previous year's earnings have converted into cash. How much of the profit actually got converted into cash. Now all these comparisons we will look at by comparing these 3 ratios, that is whether the current year's profit is above the average, how the profit has grown over the previous year, and finally how much of the profit has actually got converted into cash. Last year, or on average of the 5 years, DB Corp has earned 323 CR every year, and the recent 12 months earning is 273 CR, which is below the average by 15%. So this is not a good sign. What investors should look for is the current year's earning should be above the 5 years average. That shows strength. Let us look at how the profit has grown over the previous year or has fallen below the previous year. Here in case of DB Corp, in the previous year the company had earned 324 CR, whereas the recent earning has fallen even below that. So there was a 15% fall in profit over the previous year, and then whatever profit the company had earned in the previous year, from that it converted into cash 363 CR, which was above the profit. So this is a good sign, but generally YOY profit should also be growing. Not only that, but the recent 12 months earnings should be above the average. So 12% above the earnings was what was converted into cash. Jagran Prakashan's average profit of the last 5 years was 266 CR, and the company's current earning was 260 CR, which was very nearby to the average, so it's okay, but it just fell short by 2.05%. Last year's profit was 280 CR and the current earnings was 260 CR, so that there was again a fall in YOY profit. There was a fall of 7% from the previous year's profit after tax figure, and it managed to convert maximum of its earnings into cash. Its profits were 280 CR and its cash from operations was 390 CR, which was 39% above the earnings. That is, the cash which came in were 39% above the earnings of the company. So this is a good sign. Let us look at HMVL. Company's average profit was 159 CR over a period of 5 years, whereas in the recent 12 months the profit has fallen way below the average, and the fall is almost 54% below the average. So this is not a good sign. Even from the previous year, it has fallen by 57%. That is, from 171, it has come to 71 CR in the current 12 months. Again, not a good sign. And finally, it fell short into conversion of earnings into cash by 28%. That is, the company's profits were 171, yet their cash were only 122 CR. So all these three ratios for the company in the current year or the latest year or annual comparison is not good. Looking at HT Media, profit was 199 CR, whereas the current 12 months PAT was just 4 CR, which was way down the line below the average by 98%. Besides that, even from the previous year's profit that the company earned, it has fallen 98%. That is, in previous year the company had earned 274 CR, whereas in the recent 12 months the profit has fallen just to 4 CR. So that's a 98% fall. Next, let us look at how much profit the company has converted from the previous year into cash. So out of 274 CR of profit, the cash coming in was 308 CR, which is a good sign. So that's a 12% of gain in terms of earnings of the company. Now this is basically profit after tax to CFO is basically a value which is taken from the balance sheet of the latest financial statements of the company. In this case, this is 2018 values. So once we have the 2019 value, I may do another analysis of these same companies. UFO Moviez. Average PAT was 56 and in 12 months it has earned 66 CR, which is above the average. So this is what we would want to see. From previous year's profit too, it has gone up. So this is again a good sign, and it converted whatever profit it had earned into cash at 51% above the earnings. So all these three ratios are good for the company. UFO Moviez have done the best in terms of recent year comparison of profit with the cash, and even it has grown its profit YOY at 6.6% over the above companies. Even in terms of conversion of profit into cash is the best. HT Media has done very poor in the last year, both of growth YOY in profit as well as over the 5 years average. In terms of conversion of profit into cash, HMVL has done the worst at falling short by 28% over its earnings. Next, we'll look at the quarterly data of the company. So what we have done till now is, first of all, we looked at the 5 years cash flow and 5 years profit and how the profit of the 5 years has got converted into cash. And we also saw the free cash flow. Then we looked at the annual or the latest year's data. Now we are looking at the very micro level, that is on quarter basis. So then this completes our complete analysis of the video in terms of the range that we have selected. So look at the sales growth YOY, that is year on year growth in quarterly sales. How the company's sales have grown from one quarter of this year to the previous quarter of the previous year. DB Corp has gained 5% in its sales from the previous quarter. Jagran has gained 8% over the previous quarter of the previous year, YOY. HMVL2 has managed to gain in sales. HT Media's sales has fallen by 2% from previous year quarter. And UFO Moviez has done the best at 18%. In terms of quarter on quarter, that is from Q3 to Q4, that is from December 2018 to March 2019, sales growth or fall in the value of sales, DB Corp sales has fallen by 10%, which is not a good sign. Here too, we want a 10% growth rate both in sales as well as profit, if possible, or at least in the range of what the other group companies are earning or growing their sales at. Jagran's sales also has fallen from the previous quarter. Almost all companies' sales have fallen except UFO Moviez, which has managed to gain by 24%, both YOY as well as Q over Q. In terms of profit, that is year on year growth in quarterly profit after tax, DB Corp, Hindustan Media, HT Media all had fall in their profits. The highest profit fall was HT Media at 119% from its previous quarter. In terms of recent quarter on quarter, many companies, DB Corp, Jagran, Hindustan Media, HT Media all had a negative fall in their profits. The maximum fall again was HT Media, where it fell 162% from its previous quarter. Only UFO Moviez has managed to gain in terms of profit as well as sales. Again, when we analyze the recent quarterly data, we see that UFO Moviez has done the best in terms of growing its sales for both Q over Q and YOY, as well as having the highest profit growth rate. HT Media seems to have done the most worst in terms of not managing to grow its sales. Its profits have also fallen at quite a high rate. Next, let us look at the net worth of the company, or how big the company is. This is the total book value of the company after the company clears all its liabilities by selling all its assets. And then whatever remains is the net worth of the company, which is distributed to the shareholders. And then we'll also look at the contingent liability. These are the liabilities which may or may not arise in the future, and for which no provisions or entry has been made in the balance sheet of the company. Therefore, investors have to be careful that the contingent liability as a percentage of net worth doesn't exceed a certain limit. In this case, my criteria is that the contingent liability should not exceed 20% of the net worth. For example, if the company's net worth is 100 CR, then contingent liability should not be more than 20 CR. So in terms of net worth, or the actual value of the company after clearing all its liabilities, the biggest company of the lot seems to be HT Media at 2,475 CR, followed by other companies like DB Corp and Jagran Prakashan. These companies are big companies. Most of the companies, DB Corp and Jagran, have no contingent liability. HMVL's contingent liability is 16% of its net worth, which is still lower than 20% that I have set. HT Media's contingent liability is very high at 48% of its net worth. Sorry, we are looking at the wrong numbers. Contingent liability even for HT Media or HMVL is below 2% for both. The contingent liability is just 48 CR of the net worth. So this is also good. UFO Moviez has a very high contingent liability of 47%. That is, it has a net worth of 487 CR, whereas contingent liability stood at 229 CR, which is almost 47%. So here UFO Moviez has a negative ranking. Next, we'll look at the debt to equity ratio of the company. This is the total debt of the company divided by the funds that has been contributed by the equity shareholders. This ratio helps us understand how much is the company's borrowing against what the owners or the shareholders have contributed into the company. Now, whenever the borrowings increases at a very high rate to what the equity shareholders have contributed into the business, then it of course means that more the borrowings, more the interest cost to the company, thus less profit for the shareholders. So as far as possible, the borrowings has to be at a reasonable level. Even if the borrowing exceeds the equity shareholders contribution, then too, if the company is borrowing at a reasonable rate of interest, say 3% or 4% at a low rate of interest, then that too can be accepted as a good debt to equity ratio. So even if the company's debt to equity is around 2 times, that too would be accepted provided the company's borrowing costs are extremely low. Most of these companies' debts are below 0.5 of their equity contribution, that is half of the equity contribution. Only HT Media had the highest debt to equity ratio of 0.44, that is, debt was almost 0.44 times of the equity. Although at very reasonable levels, but in terms of peer group comparison, HT Media seems to be the highest. Next, let us look at the interest coverage. This coverage is basically calculated by dividing the EBIT, or earnings before interest and tax. This is the profit before interest and tax is deducted, and dividing that by the interest expense itself. And then this measures for how many more years can the current EBIT or current profit cover the future interest cost. So this helps us understand that even in case in the future the company's profits are very less, then too with current year's profit it can cover many years of the interest payments. Now interest payments have to be paid regardless of the company's whether making profit or losses. So this ratio basically helps us understand how the company's financial position is in terms of its liability to pay the interest cost. So in this case, what we are looking here is the number of years that the company can pay interest based on this year's profit or EBIT. DB Corp can pay off 49 years of interest cost with this year's net profit. Now this is possible because company doesn't have debt, or it has very low debt of 0.03% or 0.03 times its equity. Jagran can cover its interest cost over a period of 17 years. HMVL can cover 6 years of interest cost. Now we want these ratios to be above at least 4 years of interest coverage. HT Media's coverage has fallen below 4 times. The coverage is only for 1 year. That is, this year's profit can pay only next 1 year's interest cost. Now this is due to the current year's profit falling to just 4 CR as we saw earlier. Therefore, the EBIT cannot cover future years' interest cost. So the company will have to definitely make profit in the next year to pay off its interest cost, otherwise it will go into losses. UFO Moviez can cover 10 years of future interest payments. Next, we'll look at the debt to profit. This particular ratio helps us understand where is the borrowing when compared with its profit. This ratio checks how much debt the company is carrying and its ability to service the same, that is the borrowings, from its profit. So in other words, we can also try to understand it in this way. With this year's profit, company will take how many more years to pay off all its borrowings. So in terms of DB Corp, with this year's profit, it can very easily pay off all its borrowings that it has, because the borrowings itself is just 0.16 of this year's profit. Jagran will take 1.15 years to pay off its borrowings with this year's profit. Hindustan Media again can very easily pay off its debt because its debt itself is very low at just 0.05 times its equity. So its profit is good in terms of covering its borrowings. HT Media has the highest debt to profit, which means the debt is 3 times or almost 3.5 times more than what the company has earned in this year. UFO Moviez debt to profit is also at a reasonable level at 0.8. So in terms of all the three ratios, that is debt to equity, coverage of interest, as well as debt compared with the profit, DB Corp has done the best of all the companies. HT Media's debt to equity was the highest at 0.44 times, as well as its debt was 3 times its profit of the current year. Now this too is okay. I would even say that the debt to profit ratio, even up till 7 times, is still okay, because within 7 years the company can easily pay off its borrowings. Only when it exceeds a certain limit, then it becomes a little uncomfortable. In terms of interest coverage also, the lowest was for HT Media. Next, we'll look at the promoter shareholding and how it has changed over a period of 3 years, and if the promoters have done any pledge or given their shares as a collateral with, or has kept their shares as a collateral with financial institutions. DB Corp's Jagran Prakashan's promoters have added 0.55% more over a period of 3 years. In fact, UFO Moviez too, it seems that there's some problem with the numbers, so we'll ignore this change in promoter holding over a period of 3 years. We'll look at the current promoter holding. Most of the company's promoter holding is high, except for UFO Moviez, which is just 30%. Now here too, 30% is also good, provided the company hasn't done a heavy pledge. DB Corp's promoters have pledged 39%, which is almost nearing 40% of their shareholding of 71%. So we don't want the pledge to exceed 20% of the promoters' holding. So this is high, and it's a negative point for the company. So when the company starts pledging their shares or pledge their shares with financial institutions, what happens is, in case they are not able to clear off that pledge from the banks may sell off those shares in the open market, which may lead to fall in the share prices, which would directly affect us as investors of the company. None of the other companies have pledged their shares except UFO Moviez at a marginal 5.65% of their holdings. Next, let us analyze the debtors ratios. These are debtors to sales ratio, which basically measures how much money was still pending to be received from the accounts receivables or from debtors or from customers who have bought on credit from the company against this year's sales. So it gives us an idea as to whether the company is efficient in collecting money from its customers. So we don't want this ratio to exceed 30%. Basically here we are looking at the sales of this year and saying that the total debtors that are still pending to be collected do not or does not exceed 30% of this year's sales. DB Corp, in fact all of these companies have managed to keep their debtors below 30% of this year's sales, except UFO Moviez, which has exceeded that by 2%. Next, we'll look at how the company is collecting payment, or how fast or within how many days the company is collecting money from its customers. And what was the collection period 3 years back. Okay, so DB Corps is collecting payment within 84 days, and most of the companies like Jagran 96 days, Hindustan HMVL at 58 days. UFO Moviez is taking a lot of time to collect money from its customers at 113 days. Here our target should be not more than 90 days. That is, the company should be able to collect payment from its customers within 90 days. Or we can also say that the credit period given to customers should not exceed 3 months. 3 years back, the company's collection days were 62. Now it is increased to 84, which is not a good sign. We would want the collection period to be almost equal or nearby that of where it was 3 years back, and or else improve. That is, company should be able to collect faster from their customers. Jagran's debtor days also has increased from 74 to 96. Same is the case for HMVL from 47 to 58 days. HT Media, almost all companies' collection days have gone up. So it seems. UFO Moviez has also not done well, where debtor days were 83 years back. Now it is 113 days, highest in the group. Next, we'll look at how the company has used its inventory to convert into sales, or basically how many times over the inventory was converted into sales over the last year. And then we'll look at how the same thing has happened 3 years back, or how much or how many times more was inventory converted into sales 3 years back. DB Corp's inventory to sales ratio was 12 and 13 times. This is good, it's okay. And Jagran has managed to convert its inventory 28 times into sales. And in over a period of 3 years or 3 years back, it was 26 times. Most of these companies have done a double-digit growth of inventory into sales. This ratio on a standalone basis itself would not make much sense, because if the inventory of the current year is very less compared to its sales, then the ratio will inflate. So we'll not give any ranking to it as such, but this is just for our understanding as to how many times more the sales was when compared to its current inventory holding. Let us look at the 5 years OPM margin. This is the average operating profit margin that the company has earned during the last 5 years. Most of these companies' average operating profit margin was about 20%, except for HT Media, which fell to 13%. Here, our target should be at least 15% and above. So what happens is, from this 15% of the operating profit that the company has earned, there are a lot of deductions to be done, like depreciation expenses, interest cost, tax, and then finally we have our net profit, which should be around 10% or so, or at least 10% and above. So most of these companies have done well in terms of earning operating profit margin, except HT Media. Net profit margin of the latest year or last year data that we have, DB Corp has earned 13%. In fact, most of these companies have earned more than 10%, as we see. Next, we'll look at the net profit margin of the previous year to that, just to understand how the company was doing this year or the latest year, and then a year prior to that. Here too, if we notice, most of the companies are above 10%, except HT Media, which was 6% of net profit margin, which was the lowest in the group. As I mentioned, NPM should be at least 10% and above. So in terms of average OPM, UFO Moviez has done the best, and HT Media's OPM has fallen below 15%. And in terms of net profit margin this year as well as a year prior to that, HMVL has done the best at 19 and 20%, and UFO Moviez seems to have done the poorest at 10%, and in terms of a year prior to that, HT Media had just 6.9% of net profit margin. Let us look at the final three ratios, that is the current ratio, quick ratio, and dividend yield. Current ratio is basically a liquidity ratio which measures a company's ability to pay short-term obligation from its short-term assets. So basically what happens is we sell off all the current assets or the assets that can be sold off within 1 year and pay all the liabilities. And see, this is just a hypothetical situation which measures whether company can pay off its current liabilities using current assets. And in terms of quick ratio, here instead of using all current assets, we use only those current assets which can be immediately liquidated and turned into cash and pay off the current liabilities. So basically we want to do a test whether company is in a position to pay its liabilities comfortably. DB Corp can pay off its liabilities very easily and it has assets 2 times more than its liability. Most of the companies have a comfortable position in terms of paying off their liabilities with their assets. The dividend yield basically measures what was the dividend paid last year against this year's price. So we understand if the shareholders can expect a dividend from the company. This is just a bonus that the shareholders can expect other than the growth in the share price of the company. The highest dividend yield is by UFO Moviez at 6.6%. Jagran managed to give 3% of dividend yield. Rest all the other 3 companies are below 2%. This completes our analysis of the company. In terms of ranking, UFO Moviez has got the highest ranking of 111 points, followed by HMVL at 106 points. And we have close by DB Corp and Jagran at 94 and 93 points each. Now the problem with UFO Moviez, or the good points of UFO Moviez, is that the earnings yield of the last year is the highest, price earning is the cheapest, then its PG is the best of 3 years, its sales growth is the highest in 5 years, its return on equity growth rate is the highest at 3%. The conversion rate in 5 years from profit to cash is the highest at 116%. All the profit growth rates of the single year and even the quarterly growth rate in profit and sales is the highest for UFO Moviez. Now we'll look at the negative points. One is the net worth. It is the smallest company of the group. Although it is not a negative point, but for peer group analysis, this is the small cap company. Its contingent liability exceeds its net worth by 50%. Or in other words, besides the contingent liability being very high, we also see that it is taking very high number of days to collect money from its debtors. And its debtors are also the highest in the group companies, 32%, although at the borderline, but still it will be considered a high collection from the debtors. Even 3 years back too, it was collecting payment from its customers at the rate of 80 days. Another, I wouldn't say it's a negative, but it has been earning around 10% NPM in the last year, which was the lowest as per the group companies. HMVL is the second highest in the group, and we'll just quickly analyze that. It's 5 years historically, it has been trading at the lowest price earning multiples even in the last 3 years, and the current price earning multiple is very nearby to that average, historical average. Profit growth rate in the 5 years was the highest in the group companies. Therefore, the PG also becomes very good for the company at 0.66 times. Assets were turned over just half into sales. That is, sales were just half of the assets, which is not a very good sign. We want it to be as high as possible. Return on invested capital was very good at 60%. There was a negative in terms of how much it could not convert its profit into cash in over a period of 5 years. It fell short by 14% and the maximum in the group. So here too I would want it to be positive. Another negative is of the current year also, where its cash fell short of its profit by 28%. It's collecting payment from its customers at the fastest rate of 47 days. Its net profit margin for this year as well as the previous year was the highest in the group company. So this concludes my analysis of the group companies. Thank you for watching this video.